Brad Williams, Frugal Finance, valuing forward contracts with known yield. Forward contract is like a deal made today for something to be exchanged in the future, like agreeing to buy a car 6 months from now at a set price. In finance, there are formulas to figure out how much such a contract is worth at different times. One important thing to understand is that the value of the contract can change over time, even though the price set for the exchange stays the same. The formula to calculate the value of a forward contract says that it depends on the difference between the agreed price and the current price and how much time has passed since the agreement. If the current price is higher than the agreed price, the contract is worth something. If it's lower, the contract might be worth less or even nothing. Are forward prices and future prices equal? In theory, yes. The price for something to be delivered in the future should be the same, whether it's a forward contract or a futures contract. However, in the real world where interest rates change unpredictably, these prices might not match up exactly. Future prices of stock indices. Let's say you have a futures contract for a stock market index like the Nifty. To figure out the price of this contract, you need to consider factors like the current value of the index rate, and any dividends the stock in the index payout. The formula for this calculation takes into account these factors to give you the futures price. Suppose K is the delivery price for the contract that was negotiated some time ago. The delivery day is T, years from today, and R is the risk-free rate. The applicable forward price is the variable F of O if we negotiated the contract today. We also show F, the value of forward contract today. Understanding the significance of the variables FO, K, and F is crucial. Initially, when a forward contract begins, the delivery price represented by K is established to match the forward price F of O, and the contract's value, T or F, remains at 0. Over time, while K remains constant, as it's a fundamental aspect of the contract, the forward price fluctuates. Remember, the delivery price is K. The forward price fluctuates, causing the contract's value to shift either positively or negatively. A general result applicable to all long forward contracts, both those on investment assets and those on consumption assets, is F is equal to F of O minus K times the delivery price times EXP R of T. To see why this is correct, remember, F is the value of the contract. To see why this is correct, we use an argument analogous to those ones we use for forward rate agreements. The forward contracts versus forward rate agreements. We compare a long forward contract that has a delivery price of F of O with an otherwise identical long forward contract that has a delivery price of K. The difference between the two is only in the amount that will be paid for the underlying asset at time T. Under the first contract, this amount is F of O. Under the second contract, it is K. The cash outflow difference of F of O minus K at time T translates to a difference if F of O minus K times EXP R of T today. The contract has a delivery price F of O is therefore less valuable than the contract with delivery price K by an amount F of O minus K times EXP minus R of T. The value of the contract with the delivery price of F of O is by definition 0. It follows that the value of the contract with the delivery price of K is F of O minus K times EXP R of T. This proves that F is equal to F of O minus K times EXP R of T. Similarly, the value of a short forward contract with delivery price K is equal to K minus F of O times EXP R of T. Let's say a long forward contract on a non-dividend paying stock was entered into a long time ago. It currently has 6 months to maturity. The risk-free rate of interest with continuous compounding is 10% per annum. The stock price is 25 and the delivery price is 24. In this case, S of O is equal to 25. R is equal to 10. T, 0.5, and K, 24. Using the formula for forward price for an investment, F of O is equal to SO times EXP. F of O is equal to 25 times EXP, 1.1 times 0.5 is equal to 2628. So it's sort of like an option, if you will, all right? We've got a stock price is 25, a delivery price is 24, and the forward is 2628. You have to take into consideration the interest cost. For equation F of equals F of O minus K times EXPR of T above, the value of the forward contract is 2628 minus 24 times EXP, which is 217. From 24 to 2628, there's a bit of a premium there. And the premium could be the cost to carry. Using F is equal to, or dividends. We're looking at stocks, so I have to try to keep my commodities in line here. Think through this. So using F is equal to F of O minus K times EXP minus R of T in conjunction with F of O is equal to S of O times EXP R of T gives the following expression for the value of a forward contract on an investment asset that provides no income. So we have 25 minus 24 EXP, and this says with no dividend, right? No income. So 217 versus 217 above. Similarly, using F of O is equal F of O minus K times EXP R of T with F of O equals times EXP gives the following expression for the value of a long forward contract on an investment asset that provides known income with present value I. So here we have F is equal to S of O minus 1 minus K times EXP R of T equals 25 minus 0.10 minus 24. EXP 0.10, 0.05 is equal to 0.86. What was I again? I could say interest, but it's just saying some type of income. Finally, using F equals F of O minus K times EXPRT in conjunction with F of O equals S of O times EXPR minus QT gives the following expression for the value of a long forward contract on an investment asset that provides a known yield. This was known income. This is known yield. I'm assuming this is dividend, and this would be interest income. F is equal to EXP minus Q times T minus K. EXP R of T is equal to 25 EXP 0.10 times 0.5 minus 24 EXP 0.10 times 0.5 equals 205. You can just take these formulas, they're right here. Our forward and future prices equal. The forward price for a contract with a certain delivery date is in theory the same price as the future price for a contract with that delivery date. Forward and future prices are, in theory, no longer the same when interest rates vary unpredictably as they do in the real world. Future prices of stock indices. Consider a 3-month futures contract on the Nifty. Suppose that the stocks underlying these indexes provide a dividend yield of 1% per annum, that the current value of the index is 2,700, and that the continuous compounding risk-free interest rate is 5% per annum. In this case, R is equal to 0.05. S is O is 2,700. T, 0.25, 3 months. Q is this dividend, and then thus the futures price, F of O, shown by F is equal to 2,700 times EXP 0.5 minus 0.01 times 0.25 equals 272714. That would be the Nifty value as of today. Now, the key thing here is all about information. You're going to need to know where to find this information, and if you're working for a big bank or private equity or a hedge fund, they'll have access to this on a real-time basis. They're either using Capital IQ or Bloomberg or their own internal systems, and they probably have live feeds to this. We see this on a real-time basis. If we log into any brokerage account, this stuff is automatically built in. But if you're the new kid on the block and you have to create new products, you're going to use information like this, design something esoteric. Generally, the dividend yield on a portfolio underlying a stock index can vary from week by week throughout the year. The chosen value of Q should represent the average annualized dividend yield during the life of the contract. The dividends used for estimating Q should be those for which the ex-dividend date is during the life of the futures contract. This is something that would be, if you tried to do it manually, impossible. So that's why you pay as much as you do for Bloomberg or Capital IQ, because they have systems in place to digest all this information. Brad Williams, Frugal Finance. Thanks for watching.